I'm Hannah Bernard. You're watching Market 1 Minute, and I'm here with Rick Rule, and we are at the 3rd annual Sprott Symposium here in Vancouver. It's an outstanding success. There's been so much excitement about it. It's sold out in just a month. What do you think that excitement is attributed to?
Well, I think at Sprott we've worked 3 decades to be overnight successes. So one thing is that part of the Sprott brand, which includes 200,000 investors worldwide, is represented in this market. Of course, the increase in the gold price and the meteoric increase in gold shares has helped the mood of the conference, but the truth is that the conference grew every year too in bear market conditions. And part of it, of course, is the support of media partners like yourself over time for the Sprott brand and for this conference.
Obviously, you've gathered such a curated and incredible group of people to be here and provide information. So for investors at home, what are 3 things that they should be looking for when investing in the resource sector?
Well, I think people to begin with. This conference focuses on the sub-billion market cap, the junior sector. And people, ultimately, in the beginning of the process at least, are more important than assets. People who have been serially successful. People who are determined, people who are tenacious, people who are invested, people who are curious. That's the first part. The second part is value. Too many investors pay attention to the share price without knowing anything about the value. Money is made in the delta between price and value. Value is tough to ascertain. It requires a lot of work. Price you just have to look for. Everybody wants to look as opposed to think. You make money by thinking as opposed to by looking. So it's very important. Value is particularly important. The third thing is a strategic sense, the ability to move around the market. And we'll talk more about that later in the interview. But people need to understand that, like Wayne Gretzky said, the idea isn't to move to where the puck is, where all these big mean guys are. You skate to where the puck is going to be, where you're all alone. And people need to do that in the market too.
Now, you recently said that you think that we are about to witness the biggest shift in the resource market that you've ever seen in your very impressive career. Can you speak a little bit to that?
Yeah, let me quantify that in one way. We had a bigger move in resources in the 70s, and we had a nice move in the last decade. What's going to be interesting about this is 2 things. The severity of the bear market that we just went through. The TSXV resource index fell by 90%. Let me quantify that for your folks. It fell by half. And then it fell by half, and then for good measure it fell by half again. So you have a market that's doubled, which is a lot, but a market that's down by 90% that doubled is now down by 80%. That's the first thing. The magnitude of the decline will put the upside in focus. But the second thing is that this is a market that will see a lot of people come into it that don't know much about resources. And the sad fact is that there's going to be a tremendous transfer of capital between people who understand the resource business, understand how to speculate in resources, and newcomers coming into the markets, millions of them worldwide. Well, the underlying move in resources won't be as dramatic. The transfer of wealth between people who work hard and people who don't, in other words, the normal transfer, dispersal of wealth that takes place in a market, will be really dramatic in the next 5 years, to the benefit of some, to the detriment of many.
Now, in regards to percentage of portfolio that's invested in the resource sector, what do you think is the right percentage?
I think it depends on who you are and the rest of the composition of your portfolio. If your portfolio is, as an example, inflation hedged, if you have some moderately leveraged real estate, you can afford less by way of resources. If most of your portfolio is long bonds, where you get absolutely murdered by the degradation of the purchasing power of your capital, then you need more gold. I would suggest that for most investors, the total aggregate resource portfolio should be somewhere between 15 and 35% of resources. That doesn't mean, by the way, all speculative resources. With regards to speculative resource stocks, the answer is easy. An amount of money that you can afford to lose half of. That's the right number.
And you spoke about the composition of your portfolio, and diversification is always something that is talked about. How much is too diversified in regards to your portfolio?
With regards to these types of stocks, Hannah, the small companies, I would tell people to own the number of stocks that they are prepared to spend 1 hour a month on in terms of studying. If you're willing to spend 1 hour a month, let's say you're willing to spend 20 hours a month away from your kids, away from your job, away from golf, away from whatever you like, then you can own 20 stocks if you're going to give 20 hours. If you're going to give 60 hours, you can give 60 stocks. The truth is, for many investors who want to participate in the market itself, they want the beta of the junior gold sector, they're probably better off in the ETFs. Specifically, of course, they're better off in the Sprott ETF. But the truth is that they're better off in the ETFs. Junior stock selection involves alpha, and alpha involves work. So the correct answer to that is the number of stocks that you're willing to spend an hour a month on, and really spend it. Don't talk to us about it.
Rick, always so insightful. Congratulations on the conference, and thanks so much for chatting with us.
It's a pleasure, Hannah. Thank you for supporting the conference.